Hi, this is Mike Larson from Money and Markets TV. At the World Money Show in Orlando earlier this month, I told several hundred people about the 5 great economic deceptions that threaten to wreck their portfolios, as well as the 5 protective strategies that can help prevent that from happening. So deception number 1 is the idea that the economy is on a roll. And in truth, the recovery is sorely lacking. Just consider the facts. Consumer spending was unchanged in December. And last month, both consumer confidence and a key manufacturing index for the Chicago area slumped. Yeah, sure, we've seen a slight uptick in certain sectors, but nothing like what you'd expect if growth were coming back strongly. Then there's great deception number 2, that the jobs market is roaring back. The truth is that despite the 243,000 jobs added last month, we're not gaining much ground. If you include part-time workers and those who have just stopped looking for work because they can't find it, the real unemployment rate still stands at around 22%. Meanwhile, only 63.7% of Americans are active in the labor force. That's the worst participation rate since 1982. Great deception number 3 is that the housing market is recovering strongly. But the fact is, November home prices were down 3.7% from a year ago. Pending sales of used homes fell 3.5% in December. New home sales dropped 2.2%, and sales for all of 2011 were the worst in U.S. history. Folks, these data don't paint a picture of an improving housing market. They paint a picture of a housing market that continues to struggle. Great deception number 4 is one of the most dangerous of all, and that's that the U.S. debt load is not a major threat. But the reality is the Congressional Budget Office just forecast that the 2012 deficit will be above $1 trillion for the 4th straight year. And within the next decade, the annual interest cost, or simply paying off the debts, servicing those debts that we've already accumulated, will nearly triple to $624 billion. Finally, there's great deception number 5, that European officials are truly solving the debt crisis. Yeah, sure, Greece is maybe going to get another bailout, but there's some question as to whether that's even going to happen. And even if the country hits every one of the financial targets laid out in the deal, Greece will still be left with too much debt, making default all but inevitable down the road. Yet despite all these deceptions, stocks, commodities like oil and gold, and bond prices are generally rising. The reason? Quantitative easing, or money printing by central banks around the world, including the Federal Reserve. It has swollen their balance sheets to unprecedented levels and helped prop up asset prices artificially while doing virtually nothing to help the underlying economy. So in order to protect yourself and profit in this market environment, I recommend implementing a 5-point strategic plan. First, maintain hedges against downside risk. That means buying inverse ETFs or cheap long-term put options so you're ready when the negative fundamentals finally overwhelm the short-term impact of global money printing. Second, invest in select stocks and sectors that can hold their own in down markets and really outperform in QE-driven up markets. Third, don't chase yield in all kinds of risky investments. Instead, seek higher yields from lower risk segments of the fixed income market. I like some master limited partnerships and short-term corporate debt. Fourth, find cheap, unloved assets that you can actually buy and hold because the downside risk has largely been wrung out. Natural gas certainly qualifies in my book. And fifth, and most importantly, be ready to shift on a dime when the money printing wave shows signs of receding. Recent history tells us that when the easy money dries up, asset prices fall hard and they fall fast. I'm Mike Larson from Money and Markets TV. Thanks for watching.